Alright, so this video is going to be quick. It's dinner time. So, this is the Backseat Economist. This is my second episode. Backseat Economist is the name of the page. Could also be called Economics for Dummies. I am the lead dummy, Austin Lewis, owner and managing broker of Bay Life Brokerage financial firm. So I'm going to tie this video to another video on my Facebook page. And I'm going to force you to go back and look at that other video. Not really, I'm going to recap it. So I did a video on quantitative easing and the easing of quantitative easing that the Fed had announced, I think it was in October. So first I explained in that Facebook video what quantitative easing was, what it was meant to affect. So for those of you who did not see the video, I'll quickly backtrack. Basically, it was a program instituted in, I believe, 2008 by Ben Bernanke, who was responding to the Great Recession. And his idea was to essentially use the Fed to lubricate the economy with money, to purchase bonds from the Treasury Department, to spur them to issue out that money to banks so that that money can then be lent to the common consumer at a low interest rate, and that would then spur consumption. So consumption is a part of our GDP, a big part of our GDP equation. Over the past several decades, it's been the main driver of our GDP equation, and obviously GDP is the growth of our economy. It's what we measure. It's our gross domestic product. And so the rate of the growth that our economy sees is heavily pinned against the rate of our GDP. So in order to spur that consumption, they were lending out this money, and 12 years later, they've just now decided to stop it. It's been very difficult to stop, and we talked about some of those reasons why in the past. But essentially what happened was the stock market got hooked on this money and didn't want to have this flow of free money, cheap money, cut off. And I ended the last video basically stating I was going to explain in this video basically some of the things that happened to that money and why after 12 years of quantitative easing, all we've really seen from it are growing inflation rates and a widening inequality of our classes. So the first thing that really kind of kicked this off was the fact that when the program first was instituted, banks weren't really lending it out. It was actually deemed less risky to hold that money and either hold it in securities with the Fed or hold it within the Fed's deposit program and receive a small interest rate comparative to then lending it out at a slightly higher interest rate, but a slightly riskier, especially at the time, 2009, 2008, slightly riskier venture to risk it out to a consumer. Then, since then, a lot of money's been pumped into the economy, several $1 trillion, and so it's not quite as risky to lend out anymore. There's so much money in the economy. However, there's actually a problem now where there's few things to lend the money out for. We're running into a lack of actual assets, hard assets, and collateral to lend the money out based up against. So, a loan is based on some sort of collateral, and there's not enough essentially products or assets out there for people to take loans against. That's how much money is in the system. Hence inflation, right? The high levels of inflation you keep hearing about. And I'm trying to explain how that's come about, but also explain the misuse in a way of this program. So what the banks started doing is holding on to that money and then issuing that money to investors and to large corporations who that actually was the intent of the Fed originally. The problem here, obviously, is that the owners, the chief executives, the owners of assets and investments in this country is mainly the wealth class, the wealthy class. And so that doesn't really help the average consumer. It really only helps maybe the top 1 or 2%. And the Fed understood that. What they were hoping would happen would be that the top 1 or 2% would either create companies, businesses, corporations, or spend that money themselves, and therefore putting money back into the economy and essentially a trickle down method. So that did not happen. What's actually been happening is companies and corporations have been taking that money and a doing what are called stock buybacks. And what this is really a repurchase of their own stock, their own open market stocks and bonds. They're repurchasing these, and the reason why they're doing that is because they have a super easy, low interest way of getting money to do it. And executives of these companies can take the increased share price when you have large purchases of a stock for a company on a market. For those of you who don't invest, it typically increases the share price. Usually it's a short-term increase, but it's long enough for these executives to who often are this is a it goes deep. So executives are often uh, they're often compensated with stock options. And they are compensated with stock options because uh, it is basically a way around paying them a direct salary while still paying them more money, if that makes sense. So if they were given more cash, there's only a certain amount of cash that they can give that the corporation can then use to deduct from their taxes for the year. There are loopholes, however. Stock options are one of those where they can essentially give stock options instead of cash, and then the CEO can go ahead and sell the stock option for cash, right? So it ends up being a return in money for them anyways. But what they're also doing in between that time is using the loans that they've taken out from these banks to temporarily increase the price of the stock by doing buybacks. And then they will go ahead and sell the stock options that they were given in the form of compensation from the corporation for profit. So in effect, enriching themselves further, right, using the cheap money that the Fed was creating for the economy to enrich in their own pockets. When I think the idea behind what the Fed wanted to happen was they would take that money and reinvest it into their company and hopefully put it out in the form of dividends to their shareholders, which they argue, by the way, that the shareholders actually do receive a benefit from the stock option buybacks because typically the share price would benefit the average shareholder. And so rather than them just issuing straight cash dividends to the shareholder, they're saying that the buyback would increase the stock price and allow the shareholder to enjoy the higher stock price of their share. They can sell it or what have you. So that is a very quick explanation. I try to do that as quick as possible, but I hope it was understood. So essentially, what's happening is the money is being used by corporations and banks to enrich themselves, and unfortunately, the people who it's almost what was supposed to happen in a way because they were the intended recipients of that money. That's really the Fed doesn't really have a very good way of reaching the average consumer. So there's not really a solid method of getting money into the pocket other than to trickle it through the banks and hope that it gets lent out. That's the best way they know. But the increase in asset prices from these stock buybacks and from these speculative investments that a lot of these companies are doing as well, where they're basically dipping their toes into markets that they wouldn't normally do because they were too risky. But the money is so cheap, it's not that risky anymore. that's allowing the asset prices and the stock prices to skyrocket. But the people who hold these stocks and assets are the people that are already wealthy, right? And they're not distributing that money. They're not taking those gains and redistributing it to the general population. They're not increasing wages, at least not at a rate that's keeping up with inflation. And yes, inflation is still happening. That money is still in the open market. So as long as that money is still in the open market and is still being lent out at very cheap rates, even though it's consolidated into the top 1 or 2%, it's still being used in transactions, and it's still devaluing the currency for the rest of us, making the average price of goods higher for the rest of us. So this is a problem that's going to solve itself, because what's happening here with the slowdown is effectively the inflation is going to make it such that interest rates will have to rise. And once interest rates rise, you'll start to see a drawback on money being lent out. You'll start to see, hopefully, the Fed allowing some of these bonds to mature and for them to start tightening the reins. That's what really needs to happen at this point. Tightening the reins and allowing some of these asset bubbles that were created to go ahead and fizzle out. And hopefully the country can get back to working. And that's really that's the big thing. That's the main concern, is a lot of this money was chasing money. It wasn't producing goods. It wasn't producing products. It wasn't producing services. It was literally money buying more money and then selling itself for more money. And there was nothing being produced in the in between. And the only thing being consumed was the money itself. And that's how these asset bubbles have occurred, and that's why you haven't seen a large jump in the average wage growth, or in the or that's why you've seen such a large jump in the inequality between the top and lower classes. So that's a small piece of it. That's a small piece of it. There's a lot more to the story. Frontline did a really good expose on it. So this is the type of boring, I was going to curse, but I'm on a public YouTube channel. So this is the type of boring stuff that I like. I enjoy it. If you enjoy it too, I'd love to get a comment or a like and open up a discussion. There's other aspects of this that I don't understand that I would love, if you're watching and you do understand other pieces to it, I would love to get your input. So until next time, there will be a next time. And if you have any ideas for a next time, I'd love to hear those also. I'd love to get a like and a subscribe if you enjoy the channel or the discussion. And I'm going to go eat dinner. So hopefully everybody has a good night here.